Hello and welcome. When you're thinking about investing in a company, how do you really know if it's a healthy, profitable business? You can't just rely on the news or a friend's tip. You need to look at the company's vital signs, its financial health report. That report comes in the form of 3 key documents: the income statement, the balance sheet, and the cash flow statement. Now, I know, too many people, these documents look like a foreign language, just pages full of intimidating numbers and accounting jargon. But what if you could learn the basic vocabulary? What if you could, in just a few minutes, look at these statements and understand the story they're telling about a company's profitability, stability, and financial strength? In this video, that's exactly what we're going to do. We'll focus on the 2 most fundamental statements, the income statement and the balance sheet. We lines translate the accounting jargon into plain English and give you a simple framework for analyzing any company. You don't need to be an accountant, you just need a curious mind. Let's learn to read the story. First up, the income statement. Think of the income statement as a movie. It shows you a company as financial performance over a specific period of time, like a quarter or a full year. It answers the simple question, was the company profitable during this period? It tells the story of how money comes in and how it ultimately turns into profit. Let's walk through the key lines from top to bottom. First, you have revenue, which is sometimes called sales. This is the top line, and it's exactly what it sounds like, the total amount of money the company brought in from selling its goods or services. But revenue isn't profit. The company had to spend money to make that revenue. So, from here on, we start subtracting costs. The first major subtraction is the cost of goods sold, or COGS. These are the direct costs of creating the product. For a car company, it would be the steel, glass, and the labor to assemble the car. If you subtract the cost of goods sold from revenue, you get gross profit. This is a crucial number. It tells you how efficiently the company is producing its goods. A high gross profit is a great sign. Next, we subtract operating expenses. These are the costs of running the business that aren't directly tied to making the product. This includes things like research and development, marketing and advertising, salaries for executives and office staff, and even the office rent. What's left after subtracting these operating expenses from the gross profit is called operating income. It's also known as EBIT, which stands for earnings before interest and taxes. This number is really important because it shows the profit generated from the company's core business operations before any financing or tax effects. Finally, we account for interest expenses on any debt the company has, and of course, taxes. What remains is the famous net income, the bottom line. This is the company's total profit or loss for the period. This is the number that ultimately gets divided by the number of shares to calculate earnings per share, or EPS, a metric that investors watch very closely. So the key takeaway for the income statement is this: it shows you the flow of money in and out of the business over time. It's all about performance. Now, let's talk about the balance sheet. If the income statement is a movie, the balance sheet is a snapshot. It tells you what a company owns and what it owes at a specific point in time, like on the last day of the quarter or the year. It answers the question, what is the company's financial position right now? The balance sheet is built on a fundamental, beautiful equation that must always balance. Assets equal liabilities plus shareholders' equity. Let's break down each part. First, assets. These are everything the company owns that has value. They're usually listed in order of how easily they can be converted into cash, which is known as liquidity. You'll see current assets, this is cash itself, and other assets that can be turned into cash within a year. Think of inventory waiting to be sold, or accounts receivable, which is money owed to the company by its customers. Then you have non-current assets. These are long-term investments like property, factories, equipment, and intellectual property like patents and trademarks. Next up, liabilities. These are everything the company owes to others. Just like assets, they're split into 2 types. Current liabilities are debts that are due within a year. This could be accounts payable, which is money the company owes to its suppliers, or any short-term debt. Then you have non-current liabilities. These are long-term debts like bonds and loans that are due after more than a year. Finally, we have shareholders' equity. This is what's left over for the owners, the shareholders, after you subtract all the liabilities from all the assets. It's also known as the book value of the company. It represents the value that the shareholders theoretically own. It is made up of things like the money the company raised from selling stock in the first place and also retained earnings, which are all the cumulative profits the company has reinvested back into the business instead of paying out as dividends. The key takeaway for the balance sheet: it shows you the stock of value at a single point in time. It's about a company's position and its stability. Okay, so now that we understand the two statements, how do we use them together? You don't need to memorize every single line item. Instead, you can focus on just a few key ratios and connections to get a quick read on a company's health. First, let's look at profitability, which we get from the income statement. A great ratio is the gross margin. You calculate it by taking the gross profit and dividing it by revenue. A rising margin means the company is controlling its production costs really well. Another one is the net profit margin. This is net income divided by revenue. It tells you how much profit the company keeps from each dollar of sales. It's always a good idea to compare this to its competitors. Second, let's check financial health using the balance sheet. I call this the debt test. Just compare the total liabilities to the shareholders' equity. A company with significantly more debt than equity might be risky, especially if interest rates are going up. Another thing to look at is liquidity. Look at the current assets versus the current liabilities. If the current assets are much higher, it means the company can easily pay its short-term bills, which is a very good sign of stability. And third, here's the connection: the superstar metric that uses both statements, return on equity, or ROE. You calculate this by taking the net income from the income statement and dividing it by the shareholders' equity from the balance sheet. ROE measures how efficiently a company is using its investors' money to generate profits. A consistently high ROE is a hallmark of a great business. Let's put this into practice with a quick example. Imagine a company called Techgrow Inc. We look at its income statement, and the story it tells is that revenue is growing at a strong 20% year over year. And its net profit margin is stable at a healthy 15%. Those are good signs. Then we look at its balance sheet story. It has more cash than debt, and its current assets are double its current liabilities. This tells us it's financially stable. This simple analysis tells a powerful story. Techgrow is a growing, profitable, and financially stable company. That is a much more informed basis for an investment than just a gut feeling or a hot tip. So, let's do a quick recap. The income statement is the movie of a company's profitability over a period of time. Focus on revenue growth and the bottom line, net income. The balance sheet is a snapshot of its financial position at a point in time. Focus on the relationship between assets, liabilities, and equity. And the power combo is using them together to calculate key ratios like profit margin and return on equity to assess a company's overall quality. You really don't need to be a forensic accountant to do this. Start by just looking at these statements for companies you already know and love. Find the revenue line, find the net income. Check if they have more cash than debt. You will be amazed at how quickly you can start to separate the strong companies from the weak ones. This knowledge is your superpower. It turns you from a passive spectator into an active, informed investor. Thank you so much for watching. If you found this helpful, please give this video a like and subscribe for more content to help you on your investing journey. See you next time.